Hey fools, welcome to another edition of Consumer Countdown. I'm Mark Reith, here with the incredibly handsome Michael Finarelli and Sean O'Reilly, and we're here to talk about all the biggest news in the consumer goods sector from the past week. Now, as always, we start with the headlines, and one of the big stories from earlier this week was Coach. Shares of the luxury goods maker dropped big time on the news that it missed on profits and on revenues. So, first and foremost, guys, what happened with Coach?
Well, Mark, they disappointed substantially in North America. You know, in terms of numbers, comps were down some 13%. Yeah, that's 13%.
Yowza.
Ouch.
Yeah.
Comps, just so our readers know or viewers know, this are same-store sales, which is essentially a measure of the sales of stores that have been open at least a year. So it kind of filters out the what's going on with growth of new stores. Right. So clearly, North America is down tremendously, but China is on fire.
Yeah, China, that was shocking to me. Sales in China rose 25%,
right,
while everywhere else looked so bad. And the reason that's so surprising for me is because Coach is seeing so much competition from Michael Kors out in China. What's Coach doing right to be beating Kors right now?
They're in a country of 1.3 billion people as opposed to the U.S. market.
Okay, fair enough, fair enough.
No, the one reason they stumbled basically year over year was Michael Kors. It was actually, it's like last year, a year ago, this same time of year, they both grew, albeit Michael Kors grew at like 4 or 5 times the rate that Coach grew. Now Coach shrank and Michael Kors is still growing. In fact, Michael Kors' stock, the day that Coach fell 7% because of this release, went up 3% because everybody knew what that meant.
Yeah, all right, so Coach isn't looking so hot numbers-wise. They're still figuring out the new leadership with Victor Lewis, the new CEO who just came in. All those factors considered, are you buying Coach these days, or are you just going to stay away?
You know, I see a lot of value in Coach shares, to be completely honest with you.
Yeah.
I think there's, you know, that for as far as growth potential is concerned abroad, we're still in the very early innings. As Sean kind of noted, 1.3 billion people in China. This is a huge opportunity for Coach to expand there. And as their middle class becomes more affluent, discretionary income, you know, continues to grow, these people will be able to buy these sorts of products. So I see a long runway for Coach going forward. When you compare them to a Michael Kors, they kind of deal in 2 slightly different consumer demographics, I think. You know, Kors a little bit more to the high end. Coach is a little bit more what you would call an aspirational brand. You probably heard this term thrown around about.
But tell me more.
Basically, aspirational brand means that, you know, they're targeting consumers who want to buy a higher quality product than the low end products, but they're not going to spend $2,000 or $3,000 on a bag like you would for a Michael Kors bag. You know? So I still see a lot of value in that. I see a lot of value in their brand, and I think they can turn the ship. They can right the ship in North America too. It's still a lot of brand power. They're innovating with new products. So things look bright for Coach, in my opinion.
Okay.
For sure.
All right, yeah, you agree?
Yeah, absolutely.
All right. Moving right along, in other news, Anheuser-Busch InBev has purchased South Korea's Oriental Brewery for around $5.8 billion. Now, I say purchased, but the honest way to put this would be repurchased, since AB InBev actually sold Oriental Brewery to private equity firm KKR in 2009. Now AB InBev has to pay 3 times as much as they gave it away for just to get it back. So why is AB InBev so desperate to get into the beer market in Asia?
They, I don't think, wanted to leave in the first place. They made that sale in the depths of the Great Recession. They sold this thing to KKR and Affinity Equity Partners. They're now buying it back for $5.8 billion after selling this company for $1.8.
Yeah.
They sold it in order to shore up their balance sheet following their purchase of Anheuser-Busch. It was a hostile takeover. They took on $52 billion in debt. All the ratings agencies started being like, guys, that's a lot of debt. What are you doing? It was kind of like trading a chip, you know, that you wanted to keep, but kind of, you know, were okay parting with in order to get the big
payoff.
Big fish, the big payoff. Yeah.
Absolutely.
So now it's back. That's great and everything. The other thing is, it's kind of like, you know, looking at Asia as just a competitive space for beer sales. I mean, South Korea is actually a more mature market. Consumption's like, I don't know, 40, liters. Basically, it's considered a mature market for beer consumption. So it'll just be a steady grower. It'll be fine. It's nothing, you know, critical. It's going to change their income basically in the next year or two. But I don't know. just a piece they didn't want to part with. They just got back.
Yeah, understand.
What a lot of people have been talking though about is the growth potential in the Asia Pacific market. You know, I think going out through 2020, I think a lot of people are talking about sales growing at 13% over this time frame, which kind of outstrips what you would see here in the domestic market in the United States.
Right.
So I think that's part of the reason. But I also, you know, whenever you see like a deal or an acquisition, you know, any kind of merger or anything like this, you always have to kind of look back, take a step back and look from the shareholder's perspective and ask, you know, for the money being spent, is there really value here? You know, is this the best capital allocation decision for shareholders? And right now, I guess the jury's still out, because really ultimately comes down to, you know, the cash flow that Oriental Brewing will receive, you know, that AB InBev will make in terms of cash flow relative to the money that's putting out for this actual deal to buy back at $5.8 billion. But a few points that you could make, though, is that they do have licensing deals. Even prior to this, they had licensing deal with Oriental Brewing to sell their brands like Hoegaarden, Corona, Budweiser. So they're selling in that region. And this might be a way to kind of shore up their position, to kind of protect their position in that fast-growing market.
Right, yeah. And the other crazy thing about that sale in 2009 was they had the right to buy the company back within 5 years. That 5-year time frame would have expired this summer. And they already bought it back, so they clearly want these brands and everything.
Interesting. I actually didn't know that. That's
yeah,
very
it's
cool.
crazy, right?
Now, AB InBev isn't the only big brewer out there making these moves in emerging markets. You look at the number 2 brewer, SAB Miller. They have a huge portfolio of brands in Africa. Heineken just brought out, what was it, Tiger Pacific Brewery back in 2012. Asia Pacific Breweries, excuse me, back in 2012. Compare AB InBev to these other big players. Everyone wants a piece of the emerging market. Understandably, it's where the growth is. Who wins? Who's going to be the dominant beer maker 5 years from now?
Every time I see a deal like this, and like you hear about like, I mean, geez, McDonald's spinning off Chipotle, and now Chipotle is what it is. Or I remember back in the day, there's a Midwestern pizza chain called Donato's that McDonald's used to own, then they sold back to the guy they bought it from for less than they bought it from. Anytime I see a deal like this, I'm like, guys, what are you doing? You're paying 4 times what you sold it for. Like, what are you guys doing or whatever? And the proof is in the pudding, and the basically returns on equity and everything. Because I was wondering, you know, which of these brewers is the best business, the best absolute business. And you look at AB InBev, and their return on equity is 18%. That's actually above average for an American corporation, or actually any corporation. So that's good and everything. It's trading at a PE of 20. Their major competitor, Diego, makers of my personal favorite, Guinness, their return on equity is a whopping 34%. They're not nearly as levered either. I mean, that's actually fantastic. And you know, I have to think that 34% return on equity has to be because they aren't going around overpaying for brands that they sold 5 years ago.
Yeah, yeah, fair enough. What do you think, Mike?
You know, I mean, it's hard to say who in terms if you're picking an actual winner. I think these companies all have their respective brands that have varying strengths to different degrees in various markets, and they have opportunities, I think, abroad. And this deal is just one example of, you know, the kind of land grab that's out there to try and grab market share in these overseas markets. So I mean, I don't know if there will only be just one sole winner. I mean, I think you could have a situation where, you know, there's enough room of the pie out there right now at this point for everyone to benefit. Okay,
most important question of this segment. Favorite beer? Who are you going to? Who are you buying from? You just said Guinness. You're like,
I do love a good Guinness.
O'Reilly, you stereotype.
Yeah.
Finarelli, what do you like?
I got to go with Yingling. I'm a Pennsylvania boy.
PA, good old boy. All right.
The stock's a little overpriced, but if I were stuck on a desert island, I wouldn't, you know, be disappointed with a bunch of Sam Adams.
I like that. I like that. All right. Last but certainly not least, fast food giant McDonald's announced fourth quarter earnings earlier today. And I think they summed it up best when they said that 2013 was a challenging year. Guys, what were some of the things that McDonald's found so challenging?
Domestic growth of -1%.
A small but important detail when you're not growing in your home country, absolutely.
I actually also just read, because they're talking about shoring up and broadening the offering in their dollar menu. I just found out that apparently a lot of franchisees for McDonald's don't like the dollar menu because it costs $1 and it actually loses money.
Yeah, okay.
So
interesting.
You look at a competitor like a Yum Brands, they don't have a dollar menu and they can price things however they want.
Right.
And like one of the reasons I go to McDonald's is for the dollar sundae you can get off the dollar. You know what I mean?
Nice.
Like that's why you go there. And if they take that away, what happens?
Okay, so you mentioned Yum Brands, and Yum Brands is obviously so focused on the Asian markets for all of their growth.
For sure.
You look at McDonald's and some of their numbers, they really didn't see much growth anywhere. The only place was in Europe, which saw comparable sales increase 1% for the quarter. It's not exactly a bright spot.
It's a pretty sad day for any company when Europe is your bright spot.
Right, that's very well put. So is the future for McDonald's just trying to figure things out in the U.S., or is the future to follow in Yum's footsteps in emerging markets? What do you think, Mike?
That's a good question. You know, when I take a look at McDonald's, I still see a company with a tremendous brand. I mean, this is the leader in the quick serve restaurant segment, they're hands down. And I think what you see here in the stock is actually kind of a good example of the short-term mindset of Wall Street. Yeah, the current quarter, fourth quarter earnings and everything were down. You know, global comps were down. U.S. comps were down even further. And you saw a lot of weakness. But when you look over the past year, it wasn't nearly as grim. Not saying it was a great performance by any means, but I think I saw were global comps for the entire year, or actually, I'm sorry, global consolidated revenue and both operating income were up 2% for the entire year. Okay. So I mean, you got to take into account that this is also an extremely mature company, you know, and they're making a lot of good decisions as well. Management over the past year has returned $4.9 billion to shareholders in the form of share repurchases as well as dividends. So they're making some good, disciplined capital allocation decisions. Should they be chasing a lot of growth, especially if in a lot of their markets are currently seeing a lot of weakness? Maybe not. I think they're making some good allocation decisions, and McDonald's is still a perennial winner in my opinion.
Sounds like you're making a pretty big bull argument for McDonald's there, Mike. Are you buying McDonald's today on today's news?
I would be buying McDonald's today on today's news. It doesn't, I mean, again, this is a great brand. It's a solid company. 3.4% dividend yield. If you're looking for yield to kind of boost your return in your portfolio is not a bad thing either.
Okay. What about you, Sean? You buying?
You know, he said it's a extremely mature company. There's no exaggeration there whatsoever. I mean, it's as big as they get. I recently went to a Yum Brands Investors Day conference, and one of the things they talked about, and just all I could think about as I was reading McDonald's release, was the fact that, you know, at this conference, I mean, Yum Brands has every intention of opening 700 restaurant units in India alone this year, and they're going to do the same thing next year. I don't get any kind of enthusiasm out of McDonald's at all there.
Right.
One of the advantages that Yum Brands has is, you know, when they go to a country like, you know, India, for example, where they actually they're not even anywhere close to even where they are in China in terms of size right now, they can pick between a brand. They can be, okay, KFC will do well here. We can throw some rice in there and we're good to go. And that's actually what they were doing, because they were catering to the local market and they were just adding a bunch of vegetarian options and everything. So McDonald's can't do that.
Yeah.
They have the McDonald's, the Golden Arches, and that's it.
Yeah.
You know, so that's the trick.
Brand's not translating too well. All right. We like to dive into the Twitterverse for some of this week's most entertaining gossip. And this week's tweet comes from The Netflix Life, all one word. Now, I honestly don't know if this guy works for Netflix or just really, really likes the service. But on screen right now, we have a selection of some of his tweets just from yesterday, including, Netflix makes me happier than any boy can. Retweet if you have plans with Netflix tonight. Netflix is the highlight of my day. If only watching Netflix counted as homework, I'd be the best student at my school. And of course, who's up watching Netflix? Gentlemen, addiction is a scary thing.
I think Hastings made this up.
Right, Reed Hastings just messing around on his phone. I love Netflix. Yeah, Reed Hastings, amongst many other people, were very happy with Netflix's results yesterday. Tell me some of the numbers you guys saw that you liked, and maybe one or two that you didn't like.
Well, as far as what I can tell you from what stood out to me from the actual earnings report was the fact that there's now chatter of tiered planning, tiered pricing in their actual plans, and the fact that they might actually raise prices. And this is actually significant for me because it shows if the company can actually do this, right? Now, last time I know they tried this, they kind of broke the service off to Quick Start.
Really, really well, right?
Things kind of went a little egg-shaped for them.
Oh, really?
But you got a little bit of a different story now, okay? They've got much stronger original content, and that's the key here. Content is key. If they can actually raise prices, this will show that they've got a much wider moat, and this is something that shareholders should actually keep their eyes on.
Okay. What about you, Sean? What'd you like?
No, that is the big deal. So they got up to, what is it, 32 million subscribers?
Yes.
Sorry, 33. 33 million subscribers, 33.4. you know, I like that's fantastic. 33 million people are paying $8 a month for the service.
Yeah.
I actually saw that they're paying subscribers of 32 million, so a million people are on their free subscriptions right now or whatever. But they still only made just under $1 a share, I think. So this thing's at 100 times earnings currently.
Yeah, those valuations. What did Reed Hastings say the last time around? Don't get too excited about
get too
Netflix.
excited,
Stop buying
yeah.
Netflix, please. Yeah, he seemed pretty pleased with himself this week. Now, everyone and their mother wants to get into streaming video. You look at last week's announcement, Verizon bought Intel's media unit. That's just going to boost their FiOS
Wasn't
unit.
that kind of a failing unit, though?
It was. Well, it was failing for Intel because Intel doesn't do streaming video. Yeah, it's Intel. But FiOS, I think Verizon's FiOS unit could make some use of it. But that's the real question. Could FiOS, could any service out there really hold a candle to Netflix at this point? I mean, who else you got? Who else are you looking at in this area?
Hulu, but they couldn't even sell that thing.
Hulu,
So.
yeah, not public. Who knows who actually owns Hulu? I mean, what about you,
right.
Mike? Who are you looking at?
You know, I mean, Netflix to me, I'm not so sure anyone holds a candle. If it's anyone, it's Amazon. Currently, I think right now, Netflix reported that they closed the year at more than 44 million subscribers. So, I mean, you look at this massive subscriber base, and that's where the actual advantage comes into play, right? So what I see is what could be a virtuous cycle. You know, this huge subscriber base gives them their moat. It gives them the ability to negotiate better pricing for content.
Right.
And then when you have that better quality content, it kind of reinforces building up a higher subscriber base. More people will want Netflix as opposed to the other services like Hulu, who might not have as much high quality offerings. Amazon, I think they mentioned they still have over 20 million subscribers for Prime. Right. But a key distinction here is, which I don't think we necessarily know this number because Amazon is such a black box at times, is that of those 20 million subscribers, how many people actually take advantage of Amazon Prime Video?
True.
So it's still not nearly, I mean, 20 million, even if they all did, which I'm sure they don't, pretty sure they don't, still doesn't hold a candle to 44 million subscribers.
Right. And Reed Hastings certainly doesn't think HBO holds a candle to Netflix, as we saw from his comments, which this is a family show, I can't repeat on here. So, all that being said, the numbers look really, really good today. Can't deny it. But remember last week when net neutrality was overruled, which means that internet providers can start charging what they want for higher, faster streaming video, which is very bad news for Netflix. People seem to have forgotten about that today. Netflix is up, what, 15% today? Are you buying Netflix on today's news, or are you going to hold off and see what the future holds with net neutrality?
You know, I'm holding off, not necessarily because I'm scared of net neutrality. I mean, I think this is something for me that would affect all of the streaming players across the board. I mean, maybe it would affect Netflix a little bit more because they've got, you know, a much wider base of subscribers, they have more downloads and so forth. But on the same token, you know, I'm holding off just because of valuation. And the stock has run up so much. I'd just rather sit off and wait on the sidelines and kind of see what happens.
Reasonable.
It's kind of like a fast-moving train. You might get to the destination faster, but you're going too fast, and it could end badly.
Nice analogy. Okay. So are you hopping on the train?
No.
That's no, you're waiting it out. Taking Reed Hastings.
You don't jump into a moving in front of a moving train. You just don't.
Okay. All right. Before we go, we got to play a game. It's going to be my favorite game, buy, sell, or hold. The rules are simple. I give these guys some information about some stocks moving this week. They have to decide if they're going to buy, sell, or hold that stock based solely on the information I give them. The first company we're going to talk about is Procter & Gamble, which announces earnings on Fridays, and I'll be interested to see how the stock does. The company's had a very solid quarter back in October. It hit all-time highs in November, but analysts are starting to roll their estimates for the company back. Pre-earnings, sight unseen earnings-wise, how do you guys think? How do you think Procter & Gamble is going to do tomorrow?
They'll probably, you know, meet estimates. I wouldn't bet against the company. The thing is, I mean, the company trades for 20 times earnings. Market cap of like $220 billion.
Yeah.
At that point, you kind of start tracking the U.S. GDP growth. It's just like what happens. So, that's why I was surprised that they were pulling back on their estimates, just because U.S. growth estimates have come up recently and everything. So I don't know. It's kind of like McDonald's. It's a great dividend stock, great grower. I mean, it's got like the #1 brands for every household.
Basically everything in our homes.
I mean,
Right.
you know. So
you're buying.
Holding.
All right. What about you, Mike?
You know, for me, I could go either buy or hold on this one. And quite honestly, not because I'm necessarily a P&G investor at this point, but if I were more concerned in my portfolio as far as income were concerned, as Sean just talked about. If I was more concerned as free cash flow generator and being able to fuel dividend growth over time, then I'd be interested in Procter & Gamble. It's a great company. It has all those brands.
Absolutely.
It's innovating across those brands. Tide Pods is one example. And I think it will continue to see success.
You guys are ridiculous. You give all these bullish arguments for this company, and I'm going to hold. I'm going to wait. I'm going to play it safe.
It's really hard for a $220 billion company to move the needle.
Right, that's a very reasonable point, but God, the people need an answer. Okay.
I'm young, I gotta buy growth stocks, like Netflix.
Clearly. All right, moving right along. Sears has announced that it's closing its flagship Chicago store, which has lost millions of dollars since opening in 2001. Now this news comes on top of the prior announcement that Sears is cutting 7% of its workforce. Guys, things aren't looking so good for Sears. They haven't for a while. It feels like it's kind of accelerating, though.
For some reason, they didn't mention what they're going to do with the store.
That's a very good point.
It's in downtown Chicago on the Loop. Like, this has
you
value.
Imagine
Is
there's
that like
there's
the
some
whole
money in the
bull
store.
case for, I don't know.
Yeah, well, there's always money in the banana stand. So, you guys buy, sell, or hold Sears' future for 2014. Is this the end of Sears, frankly?
And how we know it? Good question. I mean, they talked about how they're going to revitalize stores, right, and go within like a store-within-store concept. So maybe they're becoming more of a real estate investment trust. So is this the end of Sears, the retailer? I don't know if 2014 will be the end of Sears, the retailer. I know the retail operations aren't doing very well. So eventually there could be an end coming down the road. But even if they do actually effectively kind of bring in all these other businesses and have that kind of like a mall within a mall concept for their stores, I'm very skeptical of that actual business.
I just don't know why this was an announcement on its own, because last week or 1 or 2 weeks ago they made the announcement that they were leasing the top floor of the Sears store in King of Prussia, Pennsylvania or whatever, and I was like, okay, that's step in the right direction. They're just like, yeah, we're closing the store. That's it.
It's a very fair point.
This one store, I don't know. Like, it follows JCPenney's move. They're going to close 33 stores. Like you're going to close this one store and you're going to make.
But it's their flagship. It's in their hometown. It's symbolic. It's
12 years old. I don't care.
Good point. All right, so buy, sell, or hold then on Sears.
Oh boy. Okay.
Waffling. Just
can
wishy-washy.
We should be betting like what was it? You had that picture that one time. The picture of
Hasselhoff.
Hasselhoff. Yeah.
Oh, we could just bet some Sears stock if you wanted to. If you think it's going
might as well
down.
just bet that jar of pennies.
Yeah. Very fair point. So I'm gonna put you down as a sell.
I'll sell on that news. That's
okay.
fine.
All right. Last but certainly not least, game maker Nintendo plummeted this week on the news that sales will come in horrendously lower than expected. Guys, buy, sell, or hold the future of Mario.
Sell.
Sell.
Wow, this is
Actually, no.
Actually,
Sell,
it depends.
I held it in the first place.
Okay.
It depends on what they actually do. There's value in Mario, in the intellectual property behind Mario, behind Zelda, those classic games. I think there's value in there, and especially with the fact that gaming, of course, is going more mobile, going more streaming. I think there's opportunities for the company. The fact that the Wii U is obviously they had to scale back expectations
Not so good.
so dramatically, not so good. And 3DS actually, or the Nintendo DS actually isn't performing as well. Not nearly as bad as the.
But that was their strength for a little while.
Exactly.
And now it's not so strong.
Exactly.
Bad news bears. So you're selling Nintendo, but buying the things that they own, the intellectual property, the IPs.
If management can actually take advantage of the property.
Right. Sell it to Disney. What a powerhouse that would be. My God. All right.
A bunch of Marios around. As I said, it's a sell. Had I held it in the first place. When I was first learning about investing 10, 12 years ago, I was like, oh, look at Nintendo or whatever. It amazes me how much money this company consistently loses. It's just, it's actually really sad to me. I'm like, how do you not make money doing this stuff? But I don't know. It's just they just keep taking out debt. How do they keep the store open?
Yeah,
so I don't know.
Absolutely.
It goes back to, I'm pretty sure Microsoft loses money on Xbox, right?
Yeah. Well, I don't know about the new Xbox One, but Xbox 360.
We'll wait a while.
We'll have to find out. Yeah.
So I don't know.
All right. Definitely something to keep an eye on. That's going to do it for this week's Consumer Countdown. For Michael Finarelli, Sean O'Reilly, I'm Mark Reith. Thanks for watching. We'll see you next week.